Hello there and welcome to the week ahead with me, Fiona Sincotta, Senior Market Analyst at City Index, as we look ahead to the week beginning the 24th of March. So I'm just going to ask you to take a moment and read this risk warning. I will pop myself on mute whilst we do this. Excellent. So let's crack on. I'll first of all bring up the economic calendar so that we can take a look at what we will be watching. This is the economic calendar on the City Index website, which I have then filtered for the week ahead and also the high volatility impact that is expected or potentially from these particular events. So just as we get started, I think it's always worth just taking a few moments to think about where we are as we enter the coming week. This week's obviously been a big week as far as central banks is concerned. We've seen a little bit less noise from Trump, I would say, or less impact in the markets, should I say, from Trump, and more from central bankers this week. Now, this is the S&P 500 this week. Let's not forget that the Federal Reserve left interest rates unchanged at 4.25 to 4.5%. The market actually responded positively to the Fed's meeting or announcement, which came along with an increase in inflation forecast, a decrease in growth forecast, so a stagflationary outlook, but the Fed maintained its expectations for 2 rate cuts this year on the dot plot, which brought some relief to a jittery market, which has been very concerned about the prospect of or the impact of Trump's trade tariffs on the US economy. If we have a look at this chart here, this is that steep sell-off that we've seen as those recession fears build. We've seen a bit of a recovery from that low, but I mean, broadly speaking, this chart is still very much in that downtrend phase. We would be looking sort of more for a move above that 57.70 level to really suggest that that sell-off has stabilized. So when we look ahead to next week, there are a couple of US announcements, macro points that will be watched very closely and could potentially provide further influence into the S&P 500 US stocks, as well as the US dollar. US dollar, interestingly as well, has picked up from the 5-month low that it was trading at, which it fell to this week. It fell to a low of 103.24. That was the low. We have recovered from there, but the recovery, I was going to say, overall, this is still a downward trend that we're looking at as far as the market is concerned. Again, there are several points to be watching as far as data is concerned. We're just going to stick with the US, given that that's where I think the main focus is at the moment. We've seen this sort of asset relocation away from the US towards other areas. So as far as what to be watching next week for the US, we've got on the Monday, we've got the S&P 500, so S&P Global Manufacturing PMI data. We've got the GDP figures on Thursday, and then core PCE, that's the Fed's preferred gauge for inflation, which is on Friday. So just starting off with the PMIs, I think the PMIs are going to be watched very closely because of this sort of growing uncertainty over the economic outlook for the US. With that in mind, the market's going to be looking for further clues over how the economy is holding up in light of the headwinds that it's facing from Trump's trade tariffs. Also, just to mention that I think the PMI data, it's more timely than the GDP figures that we're going to see on Thursday. GDP figures are for Q4. I mean, it's over 3 months ago. That does mean that, PMIs are more timely. So I think, any adjustments to the sort of Q4 GDP data is not really going to be terribly market moving at this late stage. As far as the PMIs for February concerned, they were the sort of the first signs, I think, of growth faltering in the US, and also we saw a sort of increased price in goods. Now, companies, when you delve deeper into that report, it showed that companies blamed the weak expansion on uncertainty and disruption caused by recent US government policies from Trump, such as tariffs, and are likely to cause higher prices in the manufacturing sector as well. Because let's not forget, we saw Trump apply tariffs, delay them, move them back, adjust them. There's been a huge amount of uncertainty, particularly with Canadian tariffs. Whilst I think the other thing to keep in mind here is that the US economy had been the fastest growing major economy in 2024, but I think that sort of exceptionalism that we saw in the US economy does appear to be faltering, as basically the PMIs showed that the activity stalled and was actually weaker than in Japan and the UK in February. Now, the composite PMIs, that's the one that sort of takes into account the services and manufacturing activity, was at 50.4 in February. That's a 17-month low. Now, investors will be watching very closely to see whether this trend continues. And if it does, then it could fuel those recession worries, particularly if we see prices goods also rising at the same time, because that would really support this stagflationary outlook, which is a difficult outlook for the Federal Reserve to handle because it requires two differing monetary policy responses. So, if you've got high inflation, sticky inflation, you don't want to be cutting interest rates because that could fuel further inflation. But at the same time, if you've got weak growth, you do want to be cutting interest rates in order to spur growth. So it's a difficult situation for the Fed to manage. And with that, if we do get weaker than expected PMI data, then that could create a further sell-off in US stocks. So that's what I'd be watching out for. Just as far as levels are concerned, S&P 500, we talked about that's the 200 SMA. It's also the low that we saw in January 2025. So that's going to be a rise above there. I think it's going to suggest that we're back into neutral territory. At the moment, we've got to get over the 5,700 level first. So, if we do get stronger than expected data, and that could ease concerns over a recession in the US, that could see a move above the 57 level. As I said, weaker than expected data. This is the level I'll be watching on the downside. It's around the 50. Oh, sorry, that's moved. Yeah, so it's around that 55.25 level. 5,500, there's sort of a support zone there. If we break below that, that creates a lower low, extending this bearish channel, and that'll bring 5,400, which is the September low, into focus. Other PMIs to be watching, we've also got the Eurozone PMIs, which will be released on Monday as well. Again, they're going to be interesting because we've seen that data from, or at least the PMIs previously showed that the Eurozone economy was broadly holding up. I mean, nothing to get excited about, but the PMI data will basically bring us more insight into how the Eurozone economy is holding up ahead of the reciprocal trade tariffs, which we're expecting to come into play in April the 2nd, on April the 2nd. Now, yesterday, ECB President Lagarde highlighted the impact that the reciprocal tariffs could have on the Eurozone economy, pointing to potential 0.3% lower growth as a result of those tariffs, should they come into play. Now, Eurozone PMI figures have basically been showing that activity in the region is broadly stuck. in a bit of a stagnation moment. Very tepid growth was seen in February. Basically, the expansion that we've been seeing in the service sector is just about covering declines that we're seeing in the manufacturing sector. So the PMI, the composite PMI, was at 50.4. 50.2 in February, and that's the level that's 50 is the level that separates expansion from contraction. So, I mean, the data just supports the view that the Eurozone economy remains stagnant after expanding by just 0.1% in the Q4 of last year. Interestingly, I think sentiment data, which is forward-looking, has been improving slightly, particularly surrounding Germany, following the election, following the passing of the vote, at least in the lower house, for increased spending by the government, which is expected to inject growth into the German economy, something that was praised by ECB President Lagarde yesterday as well. So that may help to support sort of the outlook in growth going forward, but the data that we see this month, it's far too soon to see any reflection in that. So I think most likely more of the same, this stagnatory look, which is unlikely to do too much for the euro. The euro failed to retake that 109.40 level, which was the November high. It's rebounded lower. I mean, the uptrend is still very much in play. We see sort of support down here at around the 108 level on the chart, and you know, it would take a significantly fall lower actually in order for this downtrend, or sorry, this uptrend to be broken. So I mean, you know, I'm still looking for a potential rise above that 109.40 to bring the 110 into play. If we did get stronger than expected Eurozone PMI data, that could help that move, which is, you know, could extend that move. If we get above the 110, then we'll be looking up at 112. Because this move lower, I mean, it's a consolidatory move. It's brought the RSI out of overbought territory. As I said, I think we've seen, you know, a lot of that reallocating of assets and money away from the US, and Europe is starting to look a little bit more encouraging as an investment opportunity compared to that US exceptionalism that we saw very much driving trades at the end of 2024. So levels to watch, as I said, yeah, on the upside we've got that, on the downside below there we've got the 200 SMA, which is around the 107.25 level. A move below there, you could see sellers starting to gain momentum towards 106. As far as the DAX is concerned, now the DAX reached record highs again this week, and that was on the optimism surrounding this vote that's going through and potential upbeat more spending, which is expected to boost growth. We've seen a fallback away from that record high, again very much still in the upward trend. We broke out of that rising channel, continuing to see record highs, but a couple of points we're watching out for. Is this a double top that we're looking at here? We would need to see a break below sort of this level here around the 22,200 level to confirm that. Also, we've got this bearish divergence on the RSI, so we're getting higher highs and higher lows on the price. We're actually seeing the RSI is falling, so that can tell us that momentum is falling, which could be a sign that we could see some further declines. But as we speak, that's not the case. We are still seeing very much the uptrend in focus, but yeah, there are a few signs starting to appear that a reversal may be on the cards. Just levels to watch. I mean, this rising trend line support here around 22,600, that would be the initial level to watch. We haven't broken below that. We haven't traded below that since mid-February. And then on the downside, there's this, as I said, 22,250 to 22,150. There's support zone around there to watch out for, with a break below there, sort of opening potentially the door to 21,500. If we get a move on the upside, upbeat data, potentially any news, good news from Trump regarding trade tariffs seems a little bit unlikely, but if there is anything positive, then that could obviously help the share price rise above that 22,500 to fresh all-time highs. So that is data from Eurozone. We've done the US PMIs. Also have the Bank of Japan minutes to be watching out for. So they're quite interesting, given that we have the Bank of Japan interest rate decision this week. And the Bank of Japan left rates on hold at 0.5%. That was a 17-year high, and that was after a 25 basis point hike in January. Now, Bank of Japan Governor Ueda highlighted concerns over the rising global economic uncertainties owing to Trump's trade wars. And the minutes are going to be watched really closely, really, for further insight into the discussions surrounding the rate decision, and sort of which should shed more light on the economic assessment. I think the general picture that we picked up so far from Ueda and policymakers is that the Japanese economy is on track for further rate hikes. They seem comfortable that inflation, wage growth is all moving in the right direction domestically. However, the uncertainties are to do very much with the global growth outlook. So that could take center stage at the discussions. The Bank of Japan is expected to hike rates again this year, probably in July, by about 25 basis points. Now, this is the USD Japanese yen. 5 month low down at the 146.50 level, trading within this falling trend line. And I've said this before, you know, with the Japanese yen, US dollar Japanese yen, it does tend to, when it gets into a groove, it does tend to follow that groove. So we are still in that downward trading pattern. We have tested, you know, we've recovered from that low at 146.50, tested the upper band of that falling channel. Look here, though, we've got the 50 SMA, which is about to cross below the 200 SMA, which is a death cross signal. And we've also got the upper wicks on these channels, on these recent candles. They're quite a bit longer, which suggests that there's little demand for buyers at those higher levels, which again can be a little bit of a signal that things might be coming off again soon. Just in order to test the downside, we've got 148.60 as a low. That's the low that we saw in December. Just testing that at the moment. If we get a break below that, that's going to open the door to 147, which is the 61.8 fib retracement from the 139.50 low to the 158.90 high. And then below that, this level here, which is 145. And that's sort of the areas that I'm going to be watching. That obviously creates, if we get a break below that 147, that creates a lower low as we head towards this lower level down here, which is also the lower band of that falling channel. Also, as far as Japanese yen is concerned, we've got the Japanese Tokyo inflation. Is it on here? Yeah, there we go. Tokyo inflation, which is due on Thursday. That'll be another really interesting one to watch, because obviously we're expecting to see inflation continue to tick higher, supporting or at least remain elevated around that sort of 2% level in order for the Bank of Japan to hike again. So that we will be watching closely for an impact. Hotter than expected inflation could boost the yen, pulling this price lower. So UK. The pound has been very much in focus again this week, as well as UK assets, as we've had the Bank of England monetary policy decision, where the central bank actually left interest rates unchanged at 4.5%. Again, like the Fed, highlighted and noted the uncertainties in the outlook given Trump's trade tariffs. And also, again, in line with the US, we've got that sort of stagflationary outlook where inflation is expected to tick higher and growth is expected to contract. Now, it's worth pointing out here that UK inflation data is due on the Wednesday, and then we've also got UK GDP and retail sales data, which is due on the Friday. So we're going to get some insight into both sides of this. The GDP we saw in January actually contracted by 0.1%. The Bank of England slashed its growth outlook for the UK across the year to 0.75% from 1.5%. And also, you know, watching the consumer closely, are they getting a little bit nervous about the outlook for the UK economy? Are they concerned about their jobs? In which case, we may see retail sales coming under further pressure. But as far as inflation is concerned, inflation actually ticked up to 3% in January, up from 2.5% in December. And that was ahead of estimates of 2.8%. It was also the hottest level of inflation since March 2024. So basically, inflation was driven higher by higher increased transport, food and energy costs, as well as rising industrial goods prices. So now, in response to this sort of persistent inflation, the Bank of England opted to leave interest rates unchanged and pointed to a very gradual, cautious approach to cutting rates. Now, expectations are for the CPI to ease very slightly to 2.9%, whilst core inflation is expected to ease to 3.5% from 3.7%. However, it's worth remembering that the Bank of England have forecast that inflation will rise to 3.7% by Q3 as a peak. So, you know, even if we do see a slight tick lower, we're still expecting inflation to continue rising over the next couple of months. If we do see cooler than expected inflation, that could put some downward pressure on the pound. If we see hotter than expected inflation, that could see the market rein in Bank of England rate cuts further and boost sterling. Levels to watch, this key level here at 130. We've been hovering around it for a couple of weeks. Well, a couple of weeks. We've been hovering around it. I'm exaggerating a little bit. No, 10 days or so. We've been hovering around it. Haven't really managed to get a close above that. That's going to be key. We need to get a close above the 130 level in order to be able to build on gains towards the 130.40 level. You know, with this consolidation that we're seeing here, still very much in the uptrend. It's just putting the RSA out of overbought territory. So support on the downside 129, even lower at 128.60. 200 SMAs not down here until 128. So, you know, we could see a relatively strong pullback whilst keeping within the uptrend of this rising channel that it's been in since the since mid-January, from its 121 low. So yeah, that's what I'll be watching for on that. Also, as far as growth is concerned, if for whatever reason UK growth did come in hotter than expected and the PMIs were impressive, then you know, that would all add into boosting sterling. But I think, you know, PMI data may still struggle. CPI could come in down, we see at 2.9% is what's expected. So that is what's going on in the UK. Let's just take a quick look at the FTSE. The other one that we need to talk about is gold. We'll get to that now when we talk about CPE. But here we go. Here's FTSE. We've hit up at that all-time high. That was back in early March, up at 89.10. Fallen then sharply lower down to the low of 84.60. We've seen a recovery. The recovery is back above a couple of key levels, back above the 50 SMA, back above 86.15, which is the low from February 20. But it hasn't managed to get above this rising trend line, which dates back to December 23rd. That's what buyers are going to need to take out, is that line around the 87.50. If buyers can take out that, then that could see gains towards the 8800 level. Again, that would be on the back of optimism surrounding federal rate cuts from the Bank of England, or also strong PMI data could drive either of those. On the downside, level there, 86.15, that's also the 50 SMA. That's the weekly low that we're looking at. well, it's not quite, yes it is, it's the weekly low, so that's Friday. So yeah, if we get a break below that, it'll create a lower low, opening the door to around that 84.80 level, which was the March all-time high, sorry, the May all-time high that we had back in 2024. So yes, just let's also have a quick look at gold, and then we'll get on to US core PCE. Here we go, gold reached fresh all-time highs. This is going to be one to watch. Obviously, I think the reason that we've been rising is that not only have we got the US dollar down at those 5 months lows, we've also got rising uncertainty given the outlook of the US economy, of the global economy amid sort of Trump's policies, and that is driving demand for the safe haven asset. Safe haven does well in times of geopolitical or economic uncertainty, and there certainly seems to be plenty of that around. We've also got the geopolitical uncertainty, let's not forget, with Russia, the Middle East. Russia didn't agree to the ceasefire. We've got Trump sort of addressing issues in the Middle East, or getting involved in the Middle East, which does seem to be some distance from any ceasefire. But as I said, we've got US core PCE on Friday. This could further influence the value of the dollar. It could also influence US stocks. So core PCE, that's the Fed's preferred gauge for inflation, basically rose 0.3% month on month in January, in line with forecasts. Annually, it was at 2.6%, down from 2.9%, but still well above the Fed's target level of 2%. Basically weaker than, the data comes after the Fed meeting this week, where the Fed really, highlighted that they were in no rush to cut interest rates until the data showed it was necessary. So we would need to see a considerable cooling in the data in order to support the view that the Fed was going to be cutting rates anytime sooner. So not the case. Basically, if we think about the CPI inflation report, that did come in weaker than expected, but actually the components that make up the core PCE report, which is the Fed's preferred gauge, it wasn't those ones that came in cooler. So actually they came in hotter, which means there is a potential for a hotter than expected core PCE report. That we will need to wait and see. Expectations is for it to rise to 2.8%, could come in slightly hotter. Obviously, it's worth keeping in mind that it's still too early to see the impact of Trump's trade tariffs being felt in inflation data. But if we do get hotter than expected data, that could have a downward impact on US stocks. This is the US NASDAQ. As we said, with the NASDAQ, very similar to the S&P, sharp correction, in correction territory after sharp declines over 3 weeks. Found some support down at the bottom around the 19,115 level, recovered higher, not being able to get above that 20,000 level, struggled at that resistance there, and we've seen sort of some consolidation now around this level here, which is the 19,500-ish level. Which is where it's consolidating. As I said, weak core PCE data, particularly if we've had weak PMI data at the start of the week, then you could be watching to have a breakdown of this level here, which is the 19,300, and that could open the door down to 19,000. The RSI has come out of oversold territory, but it is still below 50 and pointing downwards, which doesn't bode terribly well. 550 SMA crossing also below the 100 SMA. So various signals, but we would need to take out this level in order 19,300 to be able to create a lower low. So that is all we have time for this week. It always flies so quickly, but thank you so much for joining me, and I look forward to speaking to you again next week.